yield curve, which has been correct for all these crashes here, all the last recessions. He's predicting another crash coming very soon. So what is the yield curve? To dump down, basically the government 10-year treasury bond minus the yield of the 3-month treasury bond goes negative. I'll explain more about that later. So when this goes negative, on average, it is 12 months after we go into a recession. The recession starts. So this is an old slide. So we're actually at month 12 now. So that recession could be very soon. So sometimes it's been 12 months, sometimes 6, sometimes more at 17. But the average is about 12 months. And we're sitting right at that now. So we could have a crash right around the corner. According to the yield curve, who's been right a lot of times. So people think the yield curve, why it inverts, is because rich people like Warren Buffett, they don't see anything on the market. They want a good 10-year return that's locked in. So they pay more for the 10-year. Therefore, the yield goes down, and the 3-month goes higher than it. If you have any better explanation or any thoughts, please comment below what you think the yield curve inverts like that. That's what I've came to the conclusion for after watching a few videos. So more on this. So month 12 now, crash could be around the corner. What happens with jobs? So jobs, these are all the crashes here. Some, like the yield curve inverts, takes 13 months, then the jobs rise, so we could be around here now, we're at 12 months, so we could see these jobless things going up, or maybe the yield curve gets it wrong, but who knows, gonna have to wait and see. So continuing on, this is another slide, the Nasdaq today versus the Dow Industrials. Obviously the Nasdaq wasn't around back in 1987, or so I think, so that's just a comparison here. So look, everything looked rosy, it's going up. Oh no, we're not going to crash. People keep buying and then drops off a cliff. We could be here now. In October, we could be seeing a crash very soon. Same thing, so they say history repeats. This is 1987 versus today, and then we have 1929 versus 87. Look, goes up like this, follows that trajectory. So would have a crash in October. So going into the treasury bonds, I'm going to try and dumb it down. So it's not as if you put $1,000 in and then they pay you $10,000. Sorry, 10% a year, paid in your account each week, 10% per annum, paid in your account each week. You actually buy this treasury bond for $1,000, and then at the end of it, they give you $1,500, which will average out to 5% a year or whatever it is. So then you want to sell it early. You've held it for 1 year, so you get your 5%, whatever it was. And so therefore, someone will pay you more for it because at the end of the term, they're going to get the $1,500. So they're closer to getting that, so they'll pay more for it, which averages out to 5% anyway. So if that makes sense, so like you buy it for $1,000, at the end of 10 years you get $1,500. That's not the correct amount, but it averages out to 5% per year. So if you've held it for 1 year, you get your 5%. You get your 5% because someone pays more for it because they're closer to getting the $1,500 at the end of the treasury bill. And these are backed by the government, and the government can basically always pay them because the government will just print the money. Oh, we can't afford it, we'll just print the money. So the government just prints money, and that's why they're so stable. So here we are, the Dow Jones, everything looks good. We could be heading for a crash. So this is not just the Dow Jones going up, this is the value of the dollar going down as well, because it's basically Dow Jones versus the dollar. So 1,300 to, so basically half there. Could we see a halving, maybe a 30% drop? Who knows? So good to know, but how would you invest? Well, you say, well, why not short the market? I'm not sure if everyone short the market, but it's a very risky way to make money. Things can be overvalued and go overvalued even higher. And it's not, you can't just sit there. If you're shorting a stock, you can't just hold on to it forever because you're not getting a dividend or anything like that. So a better approach, I think, buy a company like VHY. This buys all the the best dividend stocks across the Australian market. Obviously, there's an American version of this probably. So basically, to live, people have to pay their mortgages, people have to go to shops, people have to buy metals, materials, etc. And this company owns all the best ones that do that. So you might get 7% return, but you wouldn't want to buy it now because that return's going down. So you wait for the crash, you buy in, bit of a safer bet in my opinion. And and then yeah, it goes up, and then you get that dividend. So each year goes by, and you get 10% dividend if you bought low enough, or 8% dividend. So 100,000, then you're getting $8,000 a year. 3 years passes, that's like 8 times 4. What's that? 24,000. So you made 24% basically, and then it's gone up as well. So you made some more percentages there. You could do that, or if you know something about a certain stock, it might be very, very cheap during the crash. You could buy into that, and even if that stock doesn't turn out well, the business doesn't go well, that stock might just double just off the price going up, just for, you get the point, like the business hasn't done much, but the stocks were so low it's just doubled up based on people's perspective of where it might go. So this is low risk, low return. Big go something high risk, high return, lose your money, who knows, but at least with this, it basically has to, for people to survive, this has to earn money. Well, it's not guaranteed, but it's lower risk than something else. So let me know your thoughts below. I think a good thing to invest in is a good graphite company. Graphite goes in lithium-ion battery. If the stock market crashes, you might pick up these graphite stocks for next to nothing, and even if they don't get into production, they might go from 5 cents to 15 cents, which is a 3x, which is pretty decent, and then you might pick the right one and might do a 10x, who knows. But yeah, you do have to wait for the crash, and you're obviously not going to buy at the very bottom any time. So just remember, study the yield curve because it's being correct. Also, there's another thing, when they do the last rate rise, so they've rose to 10%, and then that comes back to 6 cents, that's a signal of the last rate rise. And normally 15 months after that happens is when the recession starts. So not sure if they've done the last rate rise yet, and history might not repeat exactly. So obviously they're sort of similar, but they're all over the place. Same as the things, they're similar, but sort of scattered as well. So it might not be the same, could be 12 months, could be 20 months, who knows. So we don't really say jobs basically happen because if you don't have a job, you're not making money, you're spending less, the companies around the world are making less because you're not spending money at them, therefore their dividend goes down, therefore people pay less for that, people get scared, the stocks go down, etc, etc. It's a circular loop, but if you're smart, you might get it right. So thanks for watching, like and subscribe below, let me know your thoughts on any investing thoughts you have, anything at all, comments below, like and subscribe, and I'll see you with more videos very soon.